This is question time at Alhambra Investments, and there's always a lot to talk about. But Steve Brennan, you tell us what the question is today.
Yeah, well, the media, not known for understatement, is some of them are calling today Black Monday. Joe, we've got a little bit of a global sell-off going down. Markets down, but a lot of people are pointing to Japan, the Nikkei, which is down a lot, and saying the unwinding of the carry trade is having impacts in terms of triggering a global, worldwide meltdown, a Black Monday, or maybe just a bit of a sell-off. But could you explain it all to us?
Yeah, Black Monday, not so much. Look, I've been doing this a long time. You want to talk about Black Monday? Let's go back and talk about '87 when it went down 20% a day. Let's talk about 2008. Let's talk about any number of times when it was a hell of a lot worse than this. This is just right now, what this is a correction. I believe the NASDAQ did hit over 10% down from the high this morning. The S&P is not there yet. Actually, we could do that math here. Let's see how much the S&P is down over the last from the peak here. Hold on one second. I'll just pull this up real quick. And let's see. We'll probably hit the peak on July 31st. Let's see here. We're down. Oh my goodness. We're down 4%. Look, I don't know. Headline writers got to write about something. Actually, the 4% doesn't sound right. I think we're down a little bit more than that. But I said since July 31st. How about we do August 1st? Yeah, down 5.5. 5.5 from the high. It doesn't seem like that big a deal to me. That's a normal correction. Look, you get one of these things about every 18 months, you go down about 10%, and that's not called a correction. They're normal. They're expected. Expected. You don't know when to expect them, but you know they're going to happen. This is what happens. This is what part of being an investor, this is what it means. You have to be able to deal with drawdowns like this, 5-10%. They happen all the time. So look, last night the Nikkei was pretty bad, down 12%. That's a very, very bad day. But Japan has been on the way down. It was actually in, I think, bear market territory on Friday. So it's come down some more. Look, the yen carry trade. Let's talk about that. First of all, the reason that the Nikkei is down so much is sort of related to the yen carry trade, but it's not exactly. So let's talk about what is the yen carry trade. Yen carry trade is where a hedge fund, just for lack of a better term, leveraged money, whatever you want to call it, borrows money in yen because the interest rate there on their 10-year JGB right now is about 0.8 versus borrowing in the United States at 5+, obviously, even if you're a really high grade credit, and probably a lot more than that if you're borrow money to put it in the market. So they borrow in yen, and then they go out and use that. They convert it to other currencies, and they buy higher yielding things. They're borrowing at 0.8. This is banking 101, basically. They're borrowing at 0.8 in yen. They're lending in Mexico or in Brazil, buying, say, Mexican bonds or Brazilian bonds are yielding, 8, 9, 10%. Actually, I don't think Mexico is quite that high, but whatever. It doesn't matter. The spread is that 0.8, or actually, I think that, the JGB got up to 1. It's back down to 0.8 after the last few days. So anyway, you're borrowing at 1% roughly, and you're investing at a higher single-digit number. So you can do that by buying treasury bills here in the United States, or you could do it by buying, NVIDIA, which is obviously done pretty well. And I think a lot of these hedge funds, the big trades in hedge fund world these days have been the yen carry trade for one, and buying U.S. stocks, in particular buying U.S. growth stocks, which is why they got so pricey. The other one is the basis trade here in the United States, and nothing to do with the yen. The basis trade is the difference in the pricing of futures in the bond market versus cash bonds. That's a big trade right now. While you've got a huge short position of the 10-year Treasury note, but that's it's an arbitrage. So there's really not it's not big downside in that trade unless something happens to liquidity. In 2020 during COVID, the basis trade blew up and cost people a lot of money. But that was because of a complete lack of liquidity, which we do not have in the treasury market right now. So it's not the basis trade. That's not what's affecting things. The yen carry trade obviously is it's big. Look, the yen has gone down 50% over the last, I don't know what, 2 years, whatever it is. So obviously people are selling a lot of yen. And it's not just hedge funds. It's also what's known in the finance world as Mrs. Watanabe, which is basically the Japanese housewife, because Japanese housewives are in charge of the family money, and they don't want to own JGBs at 1%, so they go out and buy treasuries, or they buy U.S. stocks, or whatever the hell they buy. The point is that in the leverage side of this, the hedge funds, they're leveraged up, so they're not just borrowing at 0.8 and lending the same amount of money at 5. They're borrowing at 0.8 and leveraging that up to, they're borrowing the 0.8 on top of whatever capital they have. So it's a leverage trade. They've got debt in there. And if it goes against you, it's tough business, because think about it. If you're borrowing at 1 and you're investing, and just say they're buying T-bills here at 5.25. So the good thing there is the yen has been going down. So the money they've borrowed has gotten cheaper. They can buy it back with fewer dollars. They don't have to sell as many T-bills to buy back the yen that they've borrowed in. Okay, that's fine. And the dollar has been fairly stable. So good deal for them. They're leveraged up. They're probably making double digits on this based on the leverage. So what happens then when the yen starts to go the other direction? Well, now suddenly you wipe things out really quickly. The yen is up from 160 basically, or excuse me, 150 something, down to 140 this morning at one point. I think we're 143 right now. You lose 10% on the currency, and suddenly you're wiped out. You're a hedge fund, and now all your capital is gone, because you get a capital, or you get a margin call, and you got to meet the call. How do you meet the call? You meet the call by selling stuff. And so all the things that they borrowed money to buy, they had to sell those things to pay back the yen. Now, look, some of these guys are hedged to some degree, because there is a big spread in the interest rate, but none of them are fully hedged. That's not what hedge funds do. It's risk capital. That's what they're doing, is they're taking risk. So the point is that, yeah, there are some people that got caught wrong-footed here. The Japanese Bank of Japan, the Bank of Japan raised interest rates last week, the same day that the Fed didn't cut. So the Bank of Japan raised rates by 0.15%. So now their equivalent of our Fed funds is 0.25%. So you wouldn't think that such a small move would have such a big impact, but it did, because the same day the Fed did not cut rates. So now the spread between the two is still wide, but it's narrowing. And it's narrowing because now that the yen starts to go up, and all these guys have to cover their yen shorts. It is what it is. I mean, it doesn't have anything to do with the economy. I think everybody was looking at this last week and said, oh, well, it's because everybody's worried about U.S. growth. Well, the two reports that supposedly triggered this were not unusual. The ISM manufacturing index is down 20 of the last 21 months. It was negative again on Thursday. So what? We know what's going on there. Wholesalers and retailers built up a lot of inventory during COVID because of supply chain issues. They double ordered, they triple ordered to make sure they would have product on shelves. So they built up a lot of inventory, and then now that shipping has got back to normal, supply chains are getting back to normal, they've got to work the inventory down. They've been doing that for 2 years. It's still not done. That's how much of a problem these supply chains were. But, eventually it will resolve itself, and manufacturing here will pick up. And imports will probably pick up too, because we obviously import a lot of the things that we buy here. So we haven't really seen that yet. We've seen some inklings of it. We've seen the Philly Fed has gotten better. The other regional Fed surveys haven't improved. ISM popped above 50 for 1 month. What 50 is the dividing line between growth and contraction. It popped above 50 for 1 month, and now it's pulled back. It's completely normal. It doesn't mean anything. Same thing with the S&P Global PMIs, which are put out by a different group, but same type of survey, a little broader survey. They survey a wider range of size of companies, whereas the ISM is mostly large companies, or all large companies, really. So the S&P looks a little bit better than the ISM, but it's also below 50, 48 and change, whatever the number is. So, yeah, look, manufacturing is not doing well. That is not news. Everybody knows manufacturing essentially been in a recession for 2 years. So why would that trigger something on Thursday when you got confirmation that nothing's changed. That doesn't make any sense. On Friday, we got the employment report, which is also deemed to be market moving. Yeah, again, look, we added 100 and something thousand jobs. It wasn't a big number, 114,000, I think the number was, whatever it was. It doesn't matter, low 100s. Look, I've said this, I don't know how many times. You need to not be trading off of this number. It is not accurate, not even close. The plus minus on this thing is at least 100,000, and probably more. So we get 100,000 print. It could be 200,000. It could be zero. We don't freaking know. And we're not going to know for months. You know, we had a number earlier this year in April, I think it was, that was like, it was initially reported at 175, and the final revision got it down to like 105 or something like that, even lower than last Friday. But you know what? The market didn't react to that. It reacted to the initial number of being 175, saying, hey, things are great. It doesn't react to the negative revisions because nobody's paying attention. So it doesn't really make any sense to say this is because, oh, the Fed didn't cut and they're behind the curve. Maybe I'm smoking something, but it doesn't look to me like anything changed last week. Now, I'm also on record as saying I think the Fed should have cut 2 meetings ago. I think they should have cut in July. I think they should have cut at the meeting before that in May. Or did they have a meeting in June? I don't know. It doesn't matter. It should have been cut. They should have started cutting back when the Taylor rule said they should be cutting, which was back in April or May. Are they behind the curve? Are they going to cause a recession? Well, I guess that depends on what you think matters. If you think that interest rates matter to the market, well, I got news for you. The market doesn't wait for the Fed. We've already seen the 10-year Treasury note rate is hit 370 this morning. We're right now trading at 380. That's down a lot. Mortgage rates are down to 6 3/8 last week. And they're probably going to be lower today. Well, I don't know. It depends on where bonds trade. It's interesting, right? We get the sell-off today after the weekend, and supposedly this is about a weak economy. And if it is, so tell me why bonds aren't rallying. Bond yields are actually up right now on the day. So point is, the narrative doesn't make any sense. This is about some trading issue with the yen and yen carry trade and so forth. Fine, that's what it is. Now, I'll tell you what worries me, though. These things can be kind of self-fulfilling. If people think we're headed for recession, they take actions that may put us in recession. They start to pull back on spending. They start to do things a little bit differently. And this is why a lot of these indicators, recession indicators that we relied on for years, don't work anymore. Just take the yield curve for an example. And look, I'm worried about the yield curve because we are uninverting. Yield curve has been inverted for a long time, a couple of years, right? And all the bears out there, economically, oh my God, the yield curve inverted, we're going to have a recession. And they thought it was going to happen right then. Well, that's just stupid, because you go and look at the history, you can be 2 or 3 years from recession when it first inverts. The signal usually is that it uninverts, that the yield curve starts to steepen. Why? Well, because short-term rates fall faster than long-term rates. The curve steepens. That tells you that the market is expecting the Fed to cut rates. Well, why would the Fed be expected to cut rates? Well, because the economy is getting worse. That's why they would be expected. Now, that's normal. That's what we expect. And so the part where you should get worried is right now, where the yield curve is starting to steepen. In fact, we went positive this morning on the 10-2 curve. The 10-year versus the 2-year Treasury note yield actually turned positive this morning briefly. It's not positive right now, but it did turn positive. And this is what we normally see before recession. The yield curve steepens because short rates are falling faster than long rates. Well, that's happening right now. So yeah, am I worried? Yeah, absolutely. But I think that it depends on why short-term rates are coming down, why the market expects the Fed to cut. And right now, I will say, I mean, you can think about, I'm trying to remember who said it, but somebody said, the bond market has predicted 9 of the last 3 recessions or something along those lines. The market moves because it's emotional. It's not always right. So look, what we have right now is the economy has slowed down. I don't think there's any doubt about that. Nominal growth has come down some, but you look at the last GDP report, it's not a lot. We're still running a 5% nominal GDP growth year over year. Has it materially changed since the end of the second quarter? I really don't think so. Inflation, I do think, is coming down. And if the Fed were to cut rates only because inflation has come down and real growth is not, it's not a bad thing. It's a good thing. But we don't know the answer to that question yet. We don't know, why rates have come down as far as they have. All I can tell you is that in this case, I'm a little skeptical of the idea that this is going to cause recession. And here's why. The economy has slowed, yes, nominal GDP growth has slowed since it peaked in June of last year, June or July last year, or 2023. So 2022, excuse me. So inflation has been coming down, nominal growth has been coming down, and really the only part of the economy that has been hurt by the Fed's rate hikes is real estate. And it's commercial real estate with the knock-on effect to banks, and it's housing. Those are the things that have been affected. But all of those things also will be positively impacted by lower rates. Look, economies are essentially self-healing. If you have a problem in the economy because rates went too high, the thing that cures it is rates going back down, and that's what they're doing. Like I said, it's not going to wait for the Fed. The Fed can be behind the curve. The Fed is a follower all the time. They always cut too late. That's just the way it works. So I don't know that this really means all that much at this point. With mortgage rates coming back down, and by the way, I put this in the weekly commentary. There's a New York Fed does a consumer survey, and one of the things that stuck out to me in the last consumer survey was this graph they put in there called the probability of a move, and it's back up to normal. Remember, a lot of the problems in the housing market were created by this very low rates during COVID, where people locked in these really low mortgage rates, and they said, we don't want to move. I'm not going to go someplace now. I got a 3% mortgage. I'm not going to go somewhere and pay 7.5. Well, now it's 6 3/8, and it's probably going lower. So now people are starting to look at it. And by the way, it doesn't even matter if rates don't change. Eventually, people have to move. They get a new job. They retire. They do whatever they do. They're going to have to move. So now that probability of a move is rising, and now mortgage rates are coming down. That's what's going to happen. So you're going to see a pickup in activity in housing. If rates stay down here, you're going to see a pickup in housing activity. And that has a knock-on effect to the rest of the economy. It affects durable goods orders, washing machines, dryers, things like that, refrigerators, whatever, things people buy when they buy a house. So I don't think, I guess the question here is, will housing and commercial real estate recover with lower rates before a recession hits? I don't know. I think they might, because I think there's a lot of pent-up demand, especially in the housing market. But we'll see. Right now, we're kind of on watch because of the steepening yield curve. We know that's a signal that we need to pay attention to, and we are. But I would also say, look, the sentiment here has turned sour really quick. 3 days, and the sentiment is back where it was in October of last year, which was a buy point. One last thing. The VIX this morning, the volatility index, hit 60. Actually, it hit 65 this morning. Well, the only time we've ever seen 60 on the VIX or above 60 is during COVID and during 2008. I won't say that they were both buy points because you don't know. In 2008, the VIX stayed high for a long time. That's the only time it's ever done it. I don't think this is 2008. We do not have a banking problem. In general, when the VIX goes above 40, it's a buying time. It's a buying opportunity. And we're well above 40. We started this morning at 23. We went to 65, and we're at 30 and change right now. It's already coming back down because the market's off the lows. Look, I don't think this is anything right now. I'm concerned about the knock-on effect where people go, hey, the stock market's gone haywire, and I need to pull in my horns here and be a little bit less aggressive on my spending or whatever the case may be. That worries me because, like I said, it can be kind of a self-fulfilling prophecy. But right now, I don't see it. This is just a correction. It's not even a big correction. It's just a correction. And I suspect that we'll look back on this a year from now and go, what were we worried about? Because I don't think it's that big of a deal.
What are you curious about? Put your questions in the comments section down below.